So my name is Kirt Christensen, and like Reed mentioned, I am principally an internet entrepreneur. So the last 10, 15 years, actually longer than that, going back to 1995, I've been an internet entrepreneur. But as an internet entrepreneur, obviously, I've become very interested in what my money's doing and how I can make my money grow. And so over the course of the last few years, I've developed what I call my ETF tipping point system. So it's a completely mechanical system for trading bull or bear markets using ETFs for the major sectors. So as we go through this presentation, go ahead and ask questions. I can see the questions box here on my screen, so that's perfectly fine to ask questions. I can't promise that we'll answer everything in the flow of the presentation, but we will have time throughout the presentation for me to stop and take some of those questions. Now, I must apologize up front to Reed and everyone on the call. There's quite a few of you here on the call today. This is a 90-minute presentation that I've condensed down to 45 minutes. So yes, I am talking fast. I want to make sure that we get through everything and get you a lot of real value here today, of course, because you're taking time out on a Saturday, and I am as well. So I want to make sure that we have time well spent. So of course, the usual disclaimers. Past performance is not indicative of future results. We're not your investment advisor. This is for educational purposes only. First off, why should you listen to me? Like Reed mentioned, really I come from a small dairy farming town in Preston, Idaho. If you ever saw the 2004 movie Napoleon Dynamite, that's my hometown, folks. So I didn't exactly grow up with a silver spoon in my mouth, but I did get lucky, and while I was in college, we hit the first wave or the first boom of internet marketing success and corporate startups, and I was actually part of a company in Utah that we sold for $11 million back in 1998. So that gave me a good start. And in the internet business, I've consulted, flown all around the world. This is a Learjet that one of my clients flew to Provo, Utah, of all places, to pick me up and fly me back to LA. And so I've had lots of opportunities to travel the world. I've spoken at seminars all over the world, and been appeared in at least 3 books that I know of. In fact, the nudist on the late shift, there's actually a whole chapter in that book that's based on my character. So it's kind of crazy. But every time I've made money, and if you're anything like most of my customers, dentists, doctors, CPAs, those sorts of professionals, making the money isn't the hard part. The hard part is, well, what do we do after we make the money? What do we do after we have the money coming in? Because every time I've turned my money over to other investment advisors, it's bombed. And frankly, I have zero desire to kind of go to the other end of the continuum, the other extreme. I don't want to day trade or be chained to my desk. This picture kind of sums up my theory. I want to spend time with my family. I have a wife and 3 kids. And like I mentioned, I also love to travel. So I want something that allows me to make above average market returns, but not be chained to the computer, not be chained to making trade decisions in a split second. So that's what I'm looking for, way above market returns, lots of compounding, because if you know anything about compounding, you understand how powerful that is in a trading system. Any trading system that has a positive expectation and makes small gains over time with compounding is going to be pretty fabulous. And I want it to take less than 15 minutes a week. So show me the money. What have I come up with? What have I developed in ETFs and options? Well, here's the box score is what we call it. We've been running this live since, I need to change that slide, it's actually 8+ years now, since 2007. So since 2007, which, as you know, there's been a variety of markets since 2007. We haven't just been in a raging bull market or anything like that. We've had a couple of, really big bear market and a couple smaller bear markets and some sideways trading in 2011. And the results, just using single ETFs, the system averages 3.11% per month just on single ETF. So of course, you can use your imagination. If you use double ETFs, well, it's going to be roughly double that 3%. If you use options, obviously, it's going to be multiples of that as well. So here's actually how it works. Let's say on day 1, in January 2007, you were with me and you put $10,000 into each of the 9 different ETF sectors that we cover. What would have happened at that point? Well, let's show you the results. So $10,000 into each sector. Here's the actual results. Showing the equity curve on the DIA, you can see the top line is with compounding, the bottom line is without compounding. So $10,000 into a little over $140,000. On SPY, $10,000 into about $85,000. The Q's, $10,000 into about 100. On the KB, $10,000 into about 900,000. XOI is about 10,000 into 140. HUI, which is the gold index, about 400,000. about 160,000, about 850,000 on the IYR, which is real estate, XLB, which is materials, about 225. So then total, we've taken that $90,000 and turned into 3-point-something million with compounding. That's a 33 times increase in those 8 years. What if, let's just take compounding out of the equation, because of course, compounding magnifies whatever you have. I mean, obviously, if you have a losing trading system, it's going to magnify the results as well. $90,000 would have turned into $400,000 with zero compounding. That's still a 4.5 times increase. So, of course, that's what we're talking about. And I don't think we need to cover exactly what an ETF is. Let's take that as a question. Does anyone think that we need to cover the basic definition of what an ETF is? I'm assuming that most people are going to say N for no. If you want me to cover the super basics, I have some slides, but if we'll kind of look at how many Y's and N's we get coming in, of whether to cover the basics of ETFs first. Okay, again, all knows, so that's a good sign. It means we'll just move on. Everybody knows what an ETF is, why we would trade ETFs, lower expenses, tax efficiency, flexibility, consistent market performance, and mass appeal. So let's get into, well, how do I generate these signals? How are we getting 3% average per month? Well, if you think about it, if we had technical analysis and that's all that we needed, well, we've had technical analysis since the 1960s, really, right? So over 40 years of technical analysis, almost 50, and we still don't have a single holy grail of indicators that tells us exactly what stock to buy on what day on what signal, right? There's no holy grail of indicators. If you've been around trading for any length of time, you know that, right? You know that there's hundreds and hundreds and hundreds. There's more indicators than we can count. Personally, I think as many ETFs as there are, and does anybody have a count on exactly how many ETFs there are right now? The last time I checked, there was over 1,000 ETFs. Well, here's my bet. My bet is there's probably more indicators than there are actual ETFs. Now, some of them are going to be, very slightly known indicators, but think about it. There's thousands of indicators. And Larry Williams and other sorts of people, they filled books and books that you go to Barnes and Noble and you can see all sorts of indicators around. But shouldn't there just be one by now? Well, the answer to that, and this is kind of the thing that I've emphasized more than anything in my trading, is technical study by itself just doesn't do it, right? Let's face it, we really only have 3 basic elements to work with when we're looking at the data that we receive in any chart of charting pattern. No matter what kind of charting you're doing, no matter what kind of candlesticks you're looking at, or range bars, or Fibonacci's, or anything like that, right? We have price, time, and volume. Now, of those 3, 2 of them get way more concentration than the other one, right? If you see where I'm going here, which are the 2 that we tend to concentrate on the most? Well, we tend to concentrate on price and time. Well, today we're going to talk a little bit about the volume side of it and why that's an underutilized aspect of the data that we get from the market. So everyone scrambles to get their own proprietary indicator and manipulate the results in a slightly different way. But if you think about it, everybody's trying to use moving averages just in a different way. Right? There are standard deviations or Bollinger Bands, MACD, stochastics, Wildest parabolics, Keltner channels, all of that, right? And we could go on and on and on and on and on and on about indicators that use some form of a moving average. Now, even if someone's brand new to the markets, they know that moving averages are a gotcha, right? Well, if they're too short, you get whipsawed. If they're too long, you get left in the dust, missing a big market turn. Now, there's nothing wrong with moving averages per se. They do work. Well, of course, they just don't work all the time, and so that's the problem. They work in trending markets, but of course the markets don't trend all the time. I would guess the markets are flat or sideways about 40% of the time. So are you willing to count on a tool that's based on a moving average that's essentially akin to driving a car by looking in the rearview mirror? Because that's all a moving average is, folks, right? Now, I don't know if you're anything like me, but I'm a huge statistics and economics fan. Some of my favorite books are books like Freakonomics and anything by Malcolm Gladwell. And the reason for that is because it's simple common sense. But so often, things that are common sense, aren't so common. A moving average, all it's doing is what's happened, showing us what's happened in the past. It's just like driving a car, looking in the rear view mirror. Now, if you're driving down the freeway, that's going to work most of the time. The crazy thing is, right? If you see straight behind you, most likely on a freeway, it's going to be straight ahead of you. But when you get into a city, well, obviously, it doesn't work quite as well. So for the last 15 years, I've avoided moving averages like the plague. Sure, I still look at stochastics a little bit, and I don't even use candlesticks much anymore, even though I spent an intensive year studying them. The reason for that is anything that's widely available, right, is going to be monitored by other folks. And in my experience, anything that's monitored by other folks and turned into an indicator or something like that that's mass consumption that you can get for free in a charting package, it's going to be wrong. The pack is invariably wrong. So which gets us down to what do you do, Kurt? How do you come up with this volume indicator? Well, simply put, we're going to kind of gloss over this a little bit because we have an advanced crowd on with us today. We look for stocks that have options available on them, right? Sure, there are stocks that we can trade that don't have options available on, but simply put, stocks with options available or optionable stocks have a lot more volume and a lot more stable. And especially for us, because we're dealing with volume, we want things that have volume because that allows us to track something that we're going to talk about here in a second. We are really looking at ETFs. The reason we're looking at ETFs is because we're looking at entire sectors of the market. And we're going to skip over this and not spend a lot of time on this, but a lot of ETFs are either price-weighted or market cap-weighted. But in our opinion, the only sensible way to treat these ETFs to make up a sector, for example, S&P 500 with the 500 stocks, is to equally weight them. So that's how we do it. Then what we do is we look for what's called the on-balance volume for the individual stock. So that's easier said than done. So if you've been around any period of time, you've probably heard of the name of Joe Granville. Well, he's the father of what an indicator that he invented that had nothing to do with moving averages back in the 60s. He wrote about it in his book, New Key to Stock Market Profits. This was the first and most popular indicator to measure the positive and negative volume flow in a stock. The concept behind that was simple. And this is really, if you write nothing else down from my presentation today, volume precedes price. A massive spike in volume is always going to precipitate a change in price. Volume precedes price. And it doesn't necessarily have to be massive, but a change in volume is always going to precede price. So if you write nothing else down, write that down. That's what my entire system is based on. Volume precedes price. So on balance volume, if you've been around, stick with me. It's a very simplistic indicator, right? All it is really it's a cumulative total of the volume additions and subtractions forms the OBV line. So you add the period's volume when it closes up, subtract the period's volume when it closes down. That's it. So to calculate, it's very simple. For example, if today the closing price on the DIA, which is the Dow ETF, or the SPY, which is the S&P 500 ETF, if today's closing price is greater than yesterday's closing price, then the new OBV is yesterday's OBV plus today's volume. If today's closing price is less than yesterday's closing price, you subtract it, right? If it's equal, it stays the same. It's very simple. Now, it doesn't take long when you're only measuring it one time a day for the true importance of the underlying structure of these signals to get lost. Well, you can't fault Joe. You can't fault Mr. Granville, right? He invented this back in 1963, right? There were the amount of data available in 1963 was extremely minimal. If you were, they used to have these big chart books, right? And they would have weekly, monthly, and probably not even daily charts of every stock and commodity for that year. And that's how people made trade decisions. They were flipped through these chart books. So you got to give them a break. Right, but the underlying idea is genius. So what we've done to kind of solve some of those problems is we've developed what we call our ETF tipping point. So what we do is we look at every stock individually that makes up the ETF. So for example, S&P 500. Well, trick question. How many stocks are in the S&P 500? Well, 500. So we keep a running total throughout the day as to whether there's more buying or selling going on every single trade inside every single one of the 500 stocks that make up the S&P 500, tick by tick. So you may ask, well, how do you know that? How do you know whether there's more buying pressure or selling pressure on a single transaction? Well, quite simply, we evaluate the bid price and the ask price of the trade, and if the sale went off closer to the ask price, then the sellers were willing to hold out for a higher price, and the buyers were willing to pay extra to ensure that they got those shares. Conversely, if the sale went off at the bid price, then it was the sellers who were willing to move the prices down toward the buyers, who were in control, able to force the hand of the sellers. So then this establishes either a positive or negative tick flow. It will tell us whether on the whole, inside a stock, is there more buying pressure or selling pressure. So now at the end of the day, we can look at a losing day. We know that on balance it was actually bullish or bearish for the majority of the stock. So at that point, we simply do a cumulative summation for the next 13 trading days. At the end of that time, we have a pretty good idea of what percentage of the stocks are advancing on hidden power and are falling despite rising prices. So now all of this is done without the use of moving averages. So what we're really doing is, we call it the ETF tipping point. We end up with a very high confidence when something tips from inside every single stock that makes up the S&P 500, for example. When all 500 of those stocks go over 50% bullish or over 50% bearish, all of a sudden we know, well, the entire sector is trending bullish, or the entire sector is trending bearish. So of course, like we mentioned, this is all done without moving averages. By the time we get 5 hours into the market day, we have a pretty good idea what the end result is going to be, irrespective of price. So, like we mentioned, when it switches from positive to negative balance, more than 50%, we then have a sell signal for that ETF, or vice versa. So here's the great thing. So now we mentioned that the system is currently averaging 3.11% per month trading the single ETFs, and that's massively underperforming what we've done in the past. In fact, in bear markets, this system absolutely kicks butt because, do markets tend to fall faster or go up faster? Well, they tend to drop off a cliff, right? So this system has been very good in the past of precipitating those bearish events and getting a short in the market before those big events happen. So it's averaging 3% just on the single ETFs, but of course that's not the only way to trade it. If you have any imagination at all, of course you can know that, well, we can trade the underlying ETF, right? You go bullish buy when bullish, short when bearish on the S&P 500 or the SPY. You can trade the double ETF. All 9 sectors that we cover also have double ETFs. Now, here's where it gets very interesting. Well, now you can buy options on the underlying ETF. You can buy options on the double ETF. And the fifth, and probably my favorite, is we can trade what we call the best in show or the best in breed stocks in the individual lists. So here's where it gets very, very interesting because, for example, the S&P 500 goes up 10%. Well, does that mean that every stock inside the S&P 500 was actually up 10%? No, that's on average. So what we do is we break it down and we figure out which of the 500 stocks inside the S&P 500 are bringing it up, which are dragging it down. And so that allows us to either buy those underlying stocks or options on those underlying stocks, and allows us to even perform, for example, if the S&P 500 is up 10% in a trade, well, if we just bought the cream of the crop, we'd be up 15 or 20%, typically outperforming those by quite a wide margin. So let's walk through this process just kind of step by step. At this point, I'm going to assume that you've decided to forego the development of your own tick-by-tick collection platform if you're going to use our signals if you decide to do that. Of course, you're free to do this. I mean, I have fully revealed exactly what we're doing. The signals that we trade and the system that I've built, the servers that this runs on, does exactly the thing that I talked about. Collects every single stock transaction tick by tick, measures whether it's closer to the bid or the ask, and then adds it up across all the stocks across the sector, and then gives us what we call our tipping point. It's kind of like a teeter-totter that they used to have on playgrounds. It reaches a point where all of a sudden it tips from bullish to bearish, and the entire sector moves that way for short periods of time, which is the trades that we're looking at. So here's how we do it. We send out signals notifications about 12:30 p.m. Pacific or 3:30 p.m. Eastern, and we send out the signals by email and by text. You can either trade the next morning if you're not around a computer or a way to trade right then, or you can trade on market close after the market's closed and for execution the next day. You can either buy or short the ETF, or buy the double ETF, or the inverse, the options on the ETFs, or the options on the inverse ETFs. You need to hold that position until you receive a signal to reverse, or until you're stopped out. These all come with stops that are based on the average trading range of each of the ETFs. So note, you could be in a cash position if your trade gets stopped out. In that case, we wait for the next signal and re-enter the market. An ETF is either bullish or bearish. If you're only comfortable playing to the upside, then just trade when it's bullish and go to cash for that ETF when it's bearish. So here is the current updated stats of exactly what trades that we're in right now. Now, these are not a solicitation to buy or sell any sort of security or anything like that, but these are the trades that the system has signaled recently. So this is as of the close of the market yesterday, so this is as fresh as you're going to get, right? So we're currently in 4 trades, 3 of which are profitable, 2 marginally so, and then 1, on gold that's a bearish trade is doing quite well. In 13 days, we're up 10.71% on the single ETF. We did be up approximately double that on the double ETF, and magnitudes higher than that on the option and the double option. So we have the other 5 sectors, the SPY, the DI, the Qs, the real estate and materials are currently flat or in cash, and we have those 4 active trades. You can see right in the middle, these are relatively fresh trades, 12 days, 16 days, 13 days, 28 days. So here's what the chart looks like for those individual trades. So here's the KBE trade. You can see that we took that, let's see, how many days ago was that? 12 days ago on that candle at the end of that day, and it's slightly up 1.24%. The next trade is another bullish trade that's slightly down right now on the oil index, the XOI, right? This is a lot more volatile ETF to trade than some of the others. And here is a bearish trade on gold that was immediately profitable. It was entered in on that candle that then gapped down and had a big gap down the day after that. So that's the biggest runaway winning trade on the bearish side. And then a marginally profitable trade on semiconductors on that large bullish candle there. And you can see that it's in the profit right now. So do that again a couple hundred more times. So since 2007, we've actually done this over 1,024 times that we've entered and exited the market on these particular trades. So of course we did mention the options, and on the signals menu we give you the actual options to trade for these as well. So for example, if you want to figure out how much profit you'd be up on any of these trades, or in the case of the XOI, the option trade would be slightly negative, of course, because the ETF trade is slightly negative. You can look there in that column. For example, the gold bugs index is up 10.71%. If you look in the next column, it shows the option for that would be the GLD 160617. So for those of you who are not familiar with reading options charts, that means it's the option on the GLD expires in the 2016 year. In June, it's a put 106. So go check that out. See what if you would have bought that on 11/4, 13 days ago, what your percentage return would be right now, and I'm sure you'd be very impressed because obviously it's an option. It's a single ETF option. Or of course you can buy the double ETF option. Now the options on this, we're not buying what I would class as super speculative options. We're not buying out of the money options. These are in the money options, typically with a delta between about 70 and 75, typically 4 to 6 months out. You notice this is a June option, and we're currently at the end of November, so right at 6 months out. So we've gone a lot of trouble to find the best option for you using a proprietary engine that knows the way we like to trade. We're not using the options in a super speculative, 20 to 1 bet on the outsider. We're betting on the favorites. We're deep in the money options, 4 to 6 months out. Of course, I prefer to trade the double ETFs or options on the double ETFs. While they don't obviously perform 2 times as well as a single ETF, they do generally perform better. We're also working on developing other strategies for trading to the system, but for now, let's just keep it simple and let's make some money. For those of you not traded options before, some words of caution and encouragement. For most of you probably here on this call, you've probably traded options before, so I'm going to kind of breeze over this very quickly. We're not trying to purchase options that have a mispriced or a cheap option. What we're looking for is we're buying options as a proxy for buying the ETF. So let's say that we're going to buy $10,000 of each ETF, like we used in the example. If I bought all 9 ETFs, I would have tied up in my account a total of $90,000. So let's say that instead of I just took $9,000 or 10% of that capital invested in options to control the same number of shares. If I lost every single position, and if I used a 10% stop, I would have, it'd be a wash. But buying far in the future, you get the majority, if not all of your premium back, and you get the gains you're looking for without the risk. So we're using the options as a placeholder for buying the total amount of ETF shares rather than as a super speculative position. So many people look at daily options fluctuations, get a strange beast crawling around the pit of their stomach. I know how that is, but if you evaluate your losses in terms of the fraction you have invested, there's no reason to lose sleep. A position that you invested 10% of, $1,000 of what you would have put into equity, $10,000, that loses 30% of the option, really just cost you 3% of $10,000 or $300, right? So read that again and say it real time, say it fast 5 times. So the point is, don't overinvest. We're only trying to use the options to spice up and to juice up our returns, not to go hog wild and while we would have purchased 1,000 shares of the ETF, we're not going to purchase 100 option contracts. We're going to purchase 10 because that controls exactly the same amount of shares, 1,000. So we would only buy enough to return to what you expect to make on a stock-only purchase. So what about the best-in-class buying? Let's skip over this a little bit. Out of 20 or so stocks that typically make up an ETF, we know that we probably have a dozen or so that are really contributing to the gains of that stock. So, a case study I like to use, back in 2007, NASDAQ Tech Index was up 26% of the year, but 76% of those gains came from 4 stocks: Apple, Google, Amazon, and Research in Motion. So that means if we had just bought the Qs, which is the ETF that covers the NASDAQ Tech Index, you would have at least 3/4 of the stocks that we bought were pulling down our performance. So how do we do that inside of this ETF tipping point system? Well, what we do is we rank all the stocks inside of the component ETF and see how they're performing against their own ETF. So, for example, the Dow. At the time that this screenshot was taken, Alcoa, Chevron, and Boeing were the top 3 performers. If you look at the bottom of the list, Hewlett Packard, J.P. Morgan, and United Health Group were at the bottom. Now, this is this isn't a current example, so don't go out and buy Alcoa, Chevron, and Boeing if you think the DIA is bullish. But I'm saying, just as an example, you can see how they're rated relative to the performance of other stocks inside their own ETF, right? And of course, did I say options? All of these are going to have options available on them as well. So I still advocate buying more than one of the leaders, no matter what sector you may trade. Of course, there's always occasional slips in the market with a leader, but this system is normally too volatile to chase. There's not time to wait for confirmation. You'll notice in my closed out trades list, the average trade length is about 12 days, but there are quite a few trades that last 1 to 4 days. So that's what we're looking for. Who might be interested in learning to trade this way? I'm going to give you just a very, very quick special offer. We started at 45 minutes past the hour, now at 20 minutes, so we've got about, let's see, about 9 minutes before the conclusion of the presentation, before my time's up. So, like we mentioned, the box score, these are the real-world results, 3.1%, and that's underperforming, and we're not doing as well as we usually do right now, but that's what it is, going back all the way to 2001. But now, of course, imagine if you use the double ETFs or the options, or use this as a baseline to make some other decisions. That's our current trades that we're in as of close of business yesterday. But all of this really, what's on the screen right now, go ahead and type in the questions box if anybody can come up with the answer of what I'm looking at right there, or what you're looking at. A hill of beans, you're right. Several people actually got it right. The hill of beans, that is actually right. All of this really is only going to amount to a hill of beans, which means nothing if you don't take action on this. I don't come from a special background. I wasn't born with a silver spoon in my mouth or anything like that. Like I mentioned, grew up in a small dairy farming town, milking cows. So I know what hard work is like, and I know what it means to be able to build something. This is something that I've built over the last 8 years that I'm really proud of, and I like to share it with people. You know, I'm kind of a recluse. This is the first time that I've been on with the Reed, so it's an honor for me to be on with you guys. I've kind of done my own thing with my investing business. But one thing that we've successfully offered to thousands of students around the world is we teach people how to do this. So here's my offer to coach 25 of you. There's 2 program options. It's $997 for 6 months access to ETF Tipping Point, or $2,997 for 3 years access, which is a 50% discount. I hate overhead. I could get some fancy marketing guys, hire some full-time sales guys, but that's just not me. That's my office here. If you happen to be in the area in Spokane Valley, Washington, which is, you know, just Spokane is the really the only big town in eastern Washington, about 5 hours east of Seattle, just right before you get to the Idaho border. And that's where I'm sitting right there. You can see the Trading Science sign there on. I work in an office that's inside an advertising agency, actually. And, you know, we're here. We're not some fly-by-night. We're going to be around. We actually have a few students a year that come out to Spokane just to hang out in the office. But my point is, instead of dealing with big wigs and hedge fund managers, I'd rather just enjoy my free time and deal with just a few customers. So I'm putting my money where my mouth is on this, and I take the majority of the risk by giving you an ironclad 2-part performance guarantee. You know, folks, I've actually sold over $5 million worth of this ETF tipping point system over the last couple of years, and it's been a labor of love for me. So I really only want to work with people who get it, work with people who implement it and make money from it. So my performance guarantee is pretty simple. Part 1, go through the entire training, start trading live. If you don't love it, get a complete refund anytime within 30 days of ordering, no questions asked. Part 2, learn the system, use it for a full 6 months, executing all the trades as they come up. And if you don't at least make back your system investment, I'll personally work with you for free until you do. So either way, you love it and you make good money with it, or you hate it and you get your money back. I don't think that we can be much more fair than that. So here is a bonus for the first 25 people who sign up this weekend, right? Okay. Number 1, we're going to make a donation in your name to kiva.org. For those of you not familiar with Kiva, I wish we had more time to talk about this. It's microfinance for entrepreneurs in the third world. It's an opportunity for you to put up a little bit of money to help someone with their small business. And, you know, as you know, I'm an entrepreneur. This is something that I greatly support. So when you purchase the ETF Tipping Point system, we're going to make a donation in your name to kiva.org. Hopefully that'll get the ball rolling for you. You can make some further donations on your own in the future. Number 2, we're going to give you a 2-day live workshop in Spokane, Washington in March 2016. This is only for my customers. There's no other cost for the workshop other than we ask you to help cover the catering bill, which comes to about $50 a person for, you know, 4 or 5 fabulous meals here in Spokane. 2-day live workshop full of training of exactly how we implement this in our business. So to claim one of those 25 spots, you can either call our secure voicemail line at 509-720-7867, leave a detailed message with your full name and phone number, credit card number along with expiration, along with which of the choice of the 2 packages you'd like, either the 997 or the 2997. Mention you're calling from the Investor Inspiration from Reed's list today, or you can order online at etftippingpoint.com/6-month or etftippingpoint.com/3-year. So, you know, we have hundreds of members that are successfully doing this. This isn't something that we came up with yesterday. Obviously, we've been doing it in real time since 2007. It's really something that I quite enjoy. Really something that I have the best customer. I like to brag. I have the best customers in the world. These are the kind of people that I like to hang out with. So, if you're that type of person who likes to succeed in investing, this might be something for you. Of course, remember, we're going to give a donation in your name to kiva.org. Here's some of the loans that we've sponsored from other members. This is a guy with a smoothie franchise in Costa Rica, a guy getting to delivery service in Nicaragua, a cattle farmer in Costa Rica. Here's a shot of one of our most recent workshops here in Spokane. These are some of my happy students. They're not all smiling for some reason. I don't know why, but they're options traders, so, you know, they're a little bit different. This is the hotel that we hold it at here in Spokane, Washington. High class place, and cheap. So again, to claim one of those 25 spots, call a secure voicemail line, 509-720-7867, or you can order online immediately right now at etftippingpoint.com/6-month or etftippingpoint.com/3-year. So it looks like we got a few more minutes. If we have any other questions coming up, we'll go ahead and take those as as they come up. So let's go ahead and answer any questions as they come up. And we'll turn the floor back over to Reed. Thanks everyone for being here on a Saturday. You've been a fabulous audience. You've had a great amount of response to the questions we've had. So I love being on with everybody. And again, if you have any questions, give us a call, 509-720-7867, or order online, etftippingpoint.com/6-month or etftippingpoint.com/3-year. So thanks everyone.